Well, the markets in for a rough ride right now, despite strong earnings reports from several major companies. Our next guest says this is due to a shift away from the traditional beat versus miss system and toward one that focuses more on credibility and forward certainty. To explain this and break it down for us, we're joined by Martin Pelletier, Senior Portfolio Manager with Trivest Wealth at Wellington-Altus Private Counsel. Martin, thanks as always for joining us.
You betcha.
Okay, so we're moving away, and you say we're heading towards a system that focuses on credibility and forward certainty. What do you mean by that?
Yeah, I saw a chart the other day showing the World Uncertainty Index and it being an all-time high, significantly higher than any other period going back to 1995. What's really interesting is that we have this high level of uncertainty and markets are testing new highs. And you're seeing that being reflected in stock moves in this earnings season here. Those who've been missing, for example, or those who have provided guidance uncertainty, maybe some margin pressure, or have a trust us or payoff comes later, been hit pretty hard. High single digits, low double digit sell-offs. You know, you got companies like Charles Schwab, Raymond James, Netflix, Shopify, Allied Properties, and a whole bunch of others that haven't done very well because they haven't addressed that. And for those who have provided a clear path between CapEx and return, providing that peace of mind, have done well. So you've got Meta, NVIDIA, Broadcom, Intact Financial. Those companies have done well. And so it's more of a certainty and clarity and credibility vote of confidence than the actual numbers that we've seen earned over the last 3 months.
Now, do they not carry some weight, though, still? I mean, a good earnings report has got to be worth something towards credibility.
Yeah, the numbers and the fundamentals certainly do matter. But as you know, markets are forward-looking, and they want to get some comfort around that forward outlook. For example, software as a service have been highly disrupted by AI, and so despite having some strong numbers, their business model is in question. And maybe it's been oversold. I don't know, but that uncertainty is hit the sell button first, and then ask questions later.
So, are people finding certainty in precious metals right now? Is that what's driving those prices up?
Yeah, and so I mean, I think what you have to do is you have to get some help from a portfolio manager that goes beyond relationship management. So you got to look at segments of the market that are going to do well, driven by underlying macro support. And commodities have strong macro support in regards to sovereign debt risk, fiscal spending, deficit spending, money printing, and debasement. And so there's a global race, maybe an arms race per se, to accumulate commodities and shore up inventories globally. So that's copper, that's gold, that's uranium. And we've been participating through owning the high caliber companies or high caliber producers. So in copper, BHP, we like. In gold, we own Agnico. And uranium, we own Cameco.
Okay, and I just want to, did you miss silver, or did you look at what it's doing right now? It's down another 10% at this moment. Is that one of those ones that there's uncertainty?
Yeah, there's so much uncertainty, so much speculation. We did own silver, and we have profited handsomely for our clients, but it became too speculative of an asset and way too volatile. I wrote about it in my post column this week. And, when you're seeing 10% plus or minus 10% daily moves, that's not really an investment. It's more of something to bet on. We're looking at long-term commodity positioning, long-term supply fundamentals and demand strength on copper, on gold, and even uranium, and playing the AI build-out and the resources that's going to be required to support that.
And you mentioned about energy, oil. Does that fit in anywhere there? What are you looking at with that?
It does, and it's really interesting to see the divergence of Canadian oil companies or U.S. oil companies to the underlying oil price. We made a call that we were expecting lower oil prices mid-year last year, and so we reduced our energy exposure. It was the right call in oil, but it diverged. The companies did quite well, and they're paying out strong dividends despite lower oil prices. And it's nice to see the support in that sector. I still, there still is 1.5 million barrels a day of surplus capacity from OPEC. I personally think that you're going to see a ceiling on oil prices, especially ahead of U.S. midterms, as it's in the U.S. administration's best interest to keep oil prices and gasoline prices down. But I think investors in oil stocks are looking past that. And if you look out a year or 2 years from now, there's a potential for a supply shortage if demand continues to grow. And that means some good opportunities in the energy space. And so we're keeping a close eye on it, whether we want to dip our toes back into the sector or not.
All right. And I guess pretty much 100% certainty, government bonds, where do they fit in for you?
Yeah, we don't own them. And I mean, if you look at the value of your dollar, it's 75 cents from pre-COVID. I mean, you're looking at, I think someone told me the other day, it's like 30 to 50% of the money that's been generated has been printed since COVID. I mean, that's a big number. And if you have debasement, the last thing you want to own is a government bond or debt, because they're going to inflate that away. And so you're going to not do yourself any favor. So you want to find alternative strategies. Be careful on private credit, because that's experiencing a lot of difficulties right now. But we're using structured notes as a replacement with deep downside barriers, and that's working very well for our clients.
And what about bonds for companies? Where do you stand on that?
Yeah, corporate bonds. I mean, it's interesting that you're seeing yields on some corporates better than U.S. Treasuries like Microsoft. You saw that big Google deal the other day. Mm-hmm. So there's a strong demand for corporate bonds, which is good. We want to see that liquidity. It's a good sign for the broader markets that bond markets are still functioning. But there's probably more safety and more benefit in owning bonds by corporations than by governments at this moment, which is we haven't seen that before in a long time.
All right, we'll have to leave it there. Martin, thank you as always for joining us.
You bet. You take care.
Martin Pelletier is Senior Portfolio Manager with Trivest Wealth at Wellington-Altus Private Counsel.